This video is on leveraging your portfolio up and down. Imagine an investor builds a portfolio with an efficient asset mix and a risk-free money market product. The risk-free asset pays out the risk-free rate and has zero variance over the investment horizon. If you look graphically at such a linear combination between the risk-free rate and an efficient portfolio, you will notice that there is a unique linear combination that comes along with the steepest slope. The efficient portfolio with the steepest slope is called tangency portfolio, or in short, TP portfolio. The tangency portfolio is the efficient portfolio with the highest Sharpe ratio, where the Sharpe ratio is defined as the expected risk premium per unit of expected volatility. The tangent line that starts in RF and which touches the efficient frontier at the tangency portfolio is called capital allocation line. Now consider point A and point B on the graph and consider the modest risk-averse Daimler employee Pauline. Why would Pauline invest in an efficient portfolio with coordinates μA and σA when she could get for the same amount of risk an even higher expected return? Exactly, she wouldn't. Pauline would not invest in A, but rather in B. In order to reach the B portfolio, Pauline would lever up the tangency portfolio. Doing so allows Pauline to shift her mean variance indifference curve further to the northwest. Leveraging up implies that Pauline would borrow money at a cost of RF and invest that together with her own money into the TP portfolio. She would borrow as much money as is necessary to reach her optimal amount of volatility, which here in the example is sigma b. So the learning point is that if a mean variance investor can buy a risk-free asset and borrow at a risk-free rate, all optimal portfolios will be on the capital allocation line. The exact location on the capital allocation line depends on the investor's degree of risk aversion. The more risk averse the investor, the less will he allocate to the tangency portfolio and the larger his relative investment into the risk-free asset. Putting everything together shows us that a portfolio selection process of Markowitz is a two-step approach. First, you find the tangency portfolio, which is the efficient portfolio of risky assets that is expected to pay the highest Sharpe ratio. Second, based on the investor's risk aversion, you find the investor's optimal portfolio on the capital allocation line. That two-step approach is formally called two-fund separation.
Got feedback? We would love to hear it. Please drop us a line. And if you liked the video, give it a thumbs up. And don't forget to subscribe to the channel.